everybody. Welcome to TraderMerlin Show for your blood-filled Thursday afternoon session. We actually have some positive things to talk about, even though the markets look like an absolute crime scene out there, especially with crypto. A lot of stuff in double-digit declines, but that won't be our focus for today. I'm going to try to move things along very quickly, and of course, if we have some new people out there, hit that subscribe button, and of course, you can always contact me at TraderMerlin@gmail.com. Today's topic is a little bit different. We talked about the Fed unloading their balance sheet. They've actually mapped out a plan here, which is going to be $30 billion a month of treasuries and $17.5 billion a month of mortgage-backed securities for the next 3 months. But what's that going to do to the market? Why is this an issue? What should we be talking about? Well, the fact of the matter is, a lot of people think you can't get great yield out there anymore. Well, it's not true. Bill Addiss is going to join me today. We're talking about understanding ibonds, which you can get a tasty 9.6% on ibonds right now, which seems absolutely crazy. Bill, tell us more about this. How you been, my friend?
Great. How you doing, Merlin? Great to talk to you, and always good to talk to you after the Fed meetings, particularly eventful ones like this week.
Boy,
yeah, this 9.62 is just an incredible yield, and this is a product that we've hyped and talked about on your show that is an inflation index bond. And, you know, what we have talked about and I've been screaming about for 3 months is stagflation, and inflation is rising. And these bonds, these I bonds, are pegged to that inflation rate that we use, CPI. So these bonds are, I'm going to go nerdy for you for a moment, but these are actually not bonds in my world. You know, bonds in my world are things you can trade. You know, T-bills, T-notes, and so on. These are savings certificates. Mm-hmm. And these are actually very similar, in fact, they are, like the Series E and Series H savings bonds that some of us might remember from our childhood, where, you know, grandma or grandpa or some relative would give you a $25 savings bond, Series E and Series H savings bonds. Mm-hmm. Well, this is that program. There's another series of those called the I bonds. These are inflation bonds. So they're issued directly by the U.S. government. They peg their coupon every 6 months to the inflation rate for the prior 6 months. So a year ago, as inflation started rearing its ugly head, the coupon on these bonds for the period from November of last year through May of just this week was 7.12%. Now, that was at a time when treasuries were yielding 2. Mm-hmm. Now, with CPI exploding, and it's, you know, we'll talk about what it might do, but with CPI exploding, the reset of these I bonds for the next 6 months was just set at 9.62%.
Wow.
Government backed. I mean, that's 3 times the yield you can get on any other treasury instrument in the marketplace today. And you know, my frustration is the media doesn't talk about these. You know, there's nobody out there ringing the bell for these because, quite frankly, Wall Street has nothing to gain by these. Mm-hmm. You know, this is a product that's only available for the retail investor. You buy it directly from the government. There's no markup opportunity. There's no fee opportunity. And I really do think these get overlooked. And I'll include myself in this. You know, I was a bond trader at Lehman for years. I never knew about I bonds because it was a retail-oriented product.
Right.
I had done a disservice by not focusing on them more, particularly in times like this.
So I've got up the, this is Treasury Direct, so for anybody who's interested in it, and don't rush out there and buy them right now. Wait at least till the end of the show so we can finish explaining, because it's not just, hey, buy it and you get 9.62% per year. As Big Eb says, yeah, wait until November 1st when there'll be 11+%. Very likely. I mean,
but why wait?
Well, because you can get 11%.
Yes, but you can still get 11% starting on November 1st.
Oh, because it'll adjust.
Understand the way these bonds work, and that's an important note that we have to make. Everybody who owns the I bonds is now earning 9.62, no matter when you bought them.
Right.
So you're earning 9.62, and now on November 1st, a new coupon will kick in for the next 6 months. So it doesn't make any sense to me to wait. You know, that 9.62 is so attractive today. But again, there's your risk. The coupon's going to reset in 6 months. Now, if inflation goes down, the coupon could go lower. I mean, the nature of floating is it's a double-edged sword.
Mm-hmm. Yeah, and it's a 6-month reset, right, Bill? Big Eb said 6 month. Yes, it is a 6-month reset.
For everybody.
Yeah, are there limits to how much it can move in a 6-month window?
Yeah, and here's where honestly the devil gets in the details. And just because I didn't know how much time we had, because I know we want to talk about the Fed too, I'm going to be doing an XLT session on the 10th. and most of it will be dedicated to this product.
Okay.
Because there's a lot of nuances to this that I think makes sense. Because, for example, you can only buy 10,000 of them, and you buy them electronically. You know, those paper certificates I made reference to as a good visualization. In today's world, the ibonds are issued electronically. And the good news of that is you can buy any dollar amount. You don't have to buy them in a multiple. And as a retail investor, you can buy up to $10,000 of these ibonds. Now, here's a trivia. If you use ibonds and you ask to have your tax refund paid to you in ibonds, you can get them in the old paper form, and you can buy another $5,000 worth. So how's that for a trivia question?
But tonight, believe it or not, Thursday nights is my trivia night. I'm pretty sure the guy that's hosting trivia is not going to use that one, but really? I'll put it on my list of interesting ones to ask.
Really? I have no idea why that's the case, but they actually do sell or issue the paper form, but only for use of tax proceeds.
Right. So,
and the other thing I really want to stress quickly is, number one, the risk. But also, number two, these are technically 30-year investments.
Right.
These are 30-year certificates, but I really don't think the audience should think of them as 30-year investments. Because if you buy an iBond, for the first year, you're locked out. You have no liquidity. There's a lockout period there. But starting in the 13th month, you can redeem them back to the Treasury Department with only a 3-month interest penalty. That's not bad.
No.
Then from after year 5, you can redeem them with no interest penalty. So as far as I'm concerned, they should be redeemed. Looked at as worst case as a 5-year investment.
Right.
With a extended feature.
Right. And this is where we talk about market analysis. I mean, you and I, when you started doing videos with OTA several years back, we were looking at it going, the future, not right now, but the future is going to have higher rates. It's just right. What's in the cards. And I think at a certain point, let's say it's 6 years down the lines, if you own these ibonds, you've been making great interest. It's adapting to inflation. Who knows? Maybe it gets to 11, 12, 13. Who knows what inflation number it could get to? But if you're 5 years down the road and all of a sudden you're like, hey, things start to feel like they're calming down. It looks like rates are going to start to drop. Then just dump them.
Exactly. And again, you don't sell them. You redeem them, but at full interest with no penalty. So this shouldn't be viewed as a 30-year investment.
Naum says, why only 10,000? That's a good question. So you don't get greedy.
I didn't go the history lesson too much, but the reality is these whole savings certificates programs, the Series E and the Series H's, actually go back to the old war bonds program. That's how far this goes back. And even the fact that you can buy $5,000 worth if you use your tax refunds, there must be issues around the tax code, actually, that are probably driving these constrictions. Mm-hmm. But it's another trivia question I don't know the answer to. Why 10,000? Maybe because it's too good. I don't know.
Yeah, I guess it's kind of similar to why they put limits on how much you can put into your 401k every year, right? I mean,
yeah. Exactly.
Caps for some
insurance of $250,000 that hasn't been changed in the last 20 years.
So bizarre. Big Eb is right. It's $10,000 per person per year. Naum says, can you hold the bonds longer than percent? I'm not sure I understand that one, Naum. They're 30-year bonds, so you basically have a 30-year holding period for these. After 5, as Bill said, you can unload them or redeem them. I say unload, but basically get rid of them by redeeming them. After 5 years without penalty. Before that, there's going to be a slight penalty. But after 30 years, whatever that interest rate is over. The bond has matured and it's done.
Just like I might point out, if anybody in the audience has their old Series E and Series H savings certificates sitting in a drawer somewhere like I found I had, once those mature, they're a dead asset. You're not continuing to accrue any interest. So you might as well redeem them if you got them hanging around, though.
Excellent. Let me see. I'm going to see if I can bring up a chart here real quick just to put this into perspective. The comment here from Chase was, so it's a variable rate. Did I get that right? Yes, you absolutely did. And if you look here, I'm trying to find an inflation chart. Here is an example.
While you're doing that, I'm just going to follow up on his question. It's not just a variable rate. I'll go even further. It's an inflation index bond.
Correct.
So specifically tying to that CPI as your benchmark rate.
And unfortunately, this isn't giving me all the way through 2022. But here's just an example. Your yields could look like this. I have a chart here, Bill, going back in the 1960s. And let's say you bought one in 1960. I'm just making it up hypothetically. But per this chart here, if you bought back here in 1960 where it was right around 1.2%, great. But all of a sudden, we get out a few years into 66, it jumps to 3%. And then all of a sudden, by 1974, it's 11%. Then by 1980, it's 13%. this bond its yield will be readjusting every 6 months. And if the inflation rate at that time is 13.5%, your bond's going to be 13.5 or higher, depending on what the rates are. So,
right.
There you go. Just wanted to share that with you. So yes, it's
Thank you.
adjustable.
Yes, no, and really this rate, and again, another detail that we'll get into maybe later, but there's actually a variable component to these bonds and a fixed rate component. And the fixed rate component is set by the Treasury Secretary. And she actually had to make an official declaration over the weekend that the fixed rate component is zero, because the floating rate component is so high, it's already, so above market. But that means down the road, if rates do come down, the Treasury Department can include that fixed rate component that isn't there now. Mm-hmm. And the other thing, just to really highlight, because, we're starting to hear people talk about recession. Mm-hmm. And with a recession comes deflation, which literally, would be negative coupon. Well, the beauty of these bonds is if inflation goes up, your coupon will go up. But if inflation goes down, or goes to deflation, negative inflation, your coupon will never go below zero. So
Great.
You have a floor.
Yeah.
So the risk profile is not binary. You've got upside opportunity and not binary downside risk. You got a floor there.
Yep. Joe says something. He says that would probably be the best 10K investment you can make in the next 12 months. And that's a matter of opinion. There's some people who still think this market's going to all-time highs this year. There's others who think we're headed for the apocalypse. There's others who think we're going to go sideways. What I can say is that if you feel that inflation is high for the next year, then these are probably a pretty safe place to go. The only real big risk would be if all of a sudden Powell just pulled out some magic wand and all of a sudden instantly inflation was under control, which, come on, let's be honest, that's not going to happen.
And if you have that theory, I have other investments I'd love to sell you because you're in a fantasy world.
Yeah. And I think, Joe, you probably want to keep an eye on it for 5 years because, again, as Big Eb points out and Bill was mentioning, if you redeem it within that first 5-year window of time, you have to pay back 3 months worth of interest. So your rate of return is going to drop a bit if you redeem those before 5 years is up.
Yep.
Where do you go to purchase
just put
now?
the icing on the cake, because these are U.S. Treasuries, direct obligations of the U.S. government, that's 9.62 exempt from state and local tax.
Right. That was a question that came in. So, but you do pay federal tax, but no state.
Right. Yes, you're only exempt from state and local.
So here is where you would get those guys. It's actually at Treasury Direct. You can just go to Treasury Direct. There's the ibonds section right there on the left-hand side. You see there's the EE savings bonds. Then you go ibonds. You got buy, redeem, replace, reissue. So you get all your information there. The reset that you're going to see is in October. Actually, November 1st, I believe, is when the next one resets. So what's that put? June and October are the reset dates?
Well, it's October 30th, so it's November 1st is when you start earning the new date, just like on May 1st we start earning the new date.
Right, May 1st, okay.
Yeah.
Cool. All right, well, that obviously is an exciting piece. I think most people are loving the fact, thinking about 9.6% rate of return in a market that looks pretty tumultuous, especially with what we had today is a good option. How was the other parts of our bond market setting up? Anything noteworthy there? I mean, we've seen the 10-year still rising since your last appearance. It's
just a few things like a Fed meeting this week,
right?
Oh,
yeah, let's talk about that.
Let's talk about that. I just have to laugh because, we started talking about in November on these sessions that the Fed was so worried about tapering and because of the impact of what it could do that, they started in November saying, we're going to talk about talking about tapering. And then by December, as we're getting close, we might start tapering. I mean, they have been announcing this until finally we got the announcement that the Fed is going to start tapering. But again, with this need to put the distance, they've even said we're not going to start until June. Well, if this is so important, what the heck are you waiting for? Why are we, and the honest reason is, I think the markets today showed why the Fed is afraid of what the market reaction to tapering is going to be.
Yeah.
The Fed's going to start destroying the liquidity that they've been providing for the last 3 years. And they know the market was going to be nervous about that. When we started tapering back in 2018, it created problems for the market. You've all heard of the taper tantrum. And that's what the Fed's been worried about all along. And I think those worries were a bit realized today. The tapering is going to be them destroying $90 billion a month of money.
Yeah.
That's not insignificant.
After 3 months. So the first 3 months, they want it's $30 billion of treasuries and then 17.5 of mortgage-backed securities, but that will double after 3 months.
Exactly.
And you're right. I mean, at a certain point, after, let's say, 4 months down the road, you're talking about $95 billion a month of money supply being removed. And we talked about that. Look at the chart of the U.S. dollar here. This has obviously been one that a lot of people have been focusing on. We've looked at it a bunch here on this program. But that dollar index, which is right here, I mean, we actually just tiptoed into those highs we established about a week ago on April 28th. And on the long term, you look here on the weekly, this is strong like bull Tatanka. We broke through some key levels. We're right at a supply zone right now. But after that, you've got some significant potential upside here for the dollar index, which of course puts more pressure on the equity markets. And if they're removing dollars from circulation, that means less supply if demand stays the same. And let me just ask real quick for the viewers out there. I got a question for the viewers, and then Bill, you can let me know. If you have bonds that are now all of a sudden offering 9.6%, and the Fed is raising the rate for the Fed funds rate, which indirectly would give you a carry trade, meaning you could earn more interest by holding U.S. dollars, do you think there's going to be more people trying to buy dollars or less people trying to buy dollars? What do you think, Bill?
I think it makes it a little more attractive, don't you?
Yeah. So you have more people trying to buy dollars because the interest rate is higher for the carry trades. You have to have dollars to buy bonds. And all of a sudden, there's fewer dollars out there. So what this creates is almost a perfect storm for that dollar to move up significantly. I'm definitely in that bullish camp. I mean, hell, 120 on this dollar index isn't that far away. We saw it back in 1998. I know. That's when I started really active day trading. It's hard to believe that back in those years. We actually had the peak in 2000, but we're only at 103 right now. But boy, this keeps up. I think 120 is definitely on the table going forward.
Yeah. I mean, and, as you know, my business has gotten much more global. I did a program in London on Monday, and they're having the same stagflation pressures we have. Bank of England today basically just threw in the towel. They said we're going to have 10% inflation by the end of this year and negative economic growth. I'm starting to feel like the old man standing over everybody saying, be careful of that stagflation. But that's all I've been talking about for 3 months. And, here we are.
Yeah, you still got a couple factors that need to line up, but all of a sudden that last GDP print probably made you pucker up a little bit like, holy cow.
I'm glad you mentioned that because honestly, I think everyone's forgotten about that. The definition of a recession is 2 consecutive quarters of negative GDP. Well, on April 28th, we got a quarter of negative GDP. We were looking for positive 3. It came in at -1 and change. Yeah. We could be in a recession right now. And I love it when the talking heads on TV are saying, well, the pressures of a recession down the road might be growing. No, the pressures of recession now are growing because we've defined half of a recession in the first quarter of this year. What's going to happen in the second quarter? We could be in a recession now.
Yeah, I'm bringing up. There's the chart of advanced GDP, and you guys, we just have our 1 quarter. Well, I mean, we had 2 consecutive quarters due to COVID, but that was kind of an anomaly. Let's give it that.
Right.
Last time we had 2 consecutive was back in 2009, which of course you remember was a 57% drop in the equity markets. Time before that, we're back in 2000. So all of a sudden, it's starting to line up with these major market corrections. Hey, all right, nothing to be fearful, not spreading doom and gloom. It's just statistics and historical facts is all I'm looking at.
And although personally, one man's opinion, I'm not looking for a recession yet because I think, unfortunately, we have a lot more inflation pain yet to go.
Right.
When you look at the yield curve, and I don't know if you have that one I sent you, but you look at the yield curve, look how flat we're getting. The Treasury yield on the 3-year, 5-year, 7-year, 10-year, and 30-year are all within 5 basis points of each other.
Yeah.
That's not a yield curve, it's a yield line. Then add on top of it the fact the Fed's going to be bringing up short-term rates. They've told us that. Not going to take a lot for our yield curve to go inverted.
Yeah, here's the yield curve for everybody that's watching that at home. It's actually a really great, if you want to play around with this, I'm going to copy it and put it in a chat for you guys because I really think this is just an amazing tool. Because what it allows you to do is scroll left and right on this market chart over here, and it will tell you what the yield curve looked like at that respective moment in time. And you can kind of
living yield curve. I love that.
Yeah, the animated yield curve. It's really kind of a cool thing. So I'm definitely a fan of this one. But it was now that I've screwed it all up, it's flattening on the hard right edge. So here you can see May. Obviously the short-term one, we just saw that bump up to about 1%. But now all of a sudden these 3-month, the 2-year, the 5, the 7, the 10, the 20, and the 30, they're all pretty flat. I mean, this is really a flat yield curve, even though it says normal. The only reason it says normal on the screen is because that short end is stuck. That's going to.
The Fed has told us they're going to bring that up, so that's not going to look like a yield curve. That's going to look like a yield line.
Yep. Yeah, exactly. the yield plateau.
Exactly.
Let's see. The question from Big Eb. He says, Bill, since the Fed bought the mortgage securities when rates were 3%, what happens now that they're 5% when they sell them?
Well, the Fed, for the most part, great question, Ed. First off, just to explain, and there's two aspects to the question. So overall, the Fed is going to start destroying money, and going to start doing that by their maturing bonds. Now, Treasury bonds mature, and you get all of your principal back on one date. And for the last 2 years, as principal payments have been coming in, they've been reinvesting it in more bonds, but now they're going to start destroying that money. Mm-hmm. Well, mortgage-backed bonds, irrespective of what the coupon is, mortgage-backed bonds pay back their principal on monthly installments, just like your mortgage payment. So the Fed has been taking those principal payments and reinvesting them back into the market. Now, with their targets that they just announced this week, within 3 months, the Fed is going to start destroying $60 billion in Treasury money and $35 billion in mortgage money. Well, the reality is, for them to achieve that, they're just not going to take the existing principal that's been coming in. They're actually going to have to go out and start selling bonds. Mm-hmm. The Fed had been the biggest buyer for the last 2 years, and in 3 months, the Fed is going to start becoming a seller. So that's going to drive down Treasury prices, drive up yields. And the fact that the Fed has been so involved in the mortgage, so that's what's going to happen in general. So whether it's the mortgage portfolio or the Treasury portfolio, the Fed's going to have to start selling bonds to meet this fulfillment of destroying as much money as they have committed to. Now, on top of that, though, and also embedded in the question is, I would ask the question, why has the Fed been buying all these mortgage-backed bonds? Back in 2008, when the Fed introduced quantitative easing, we had a mortgage crisis. It made sense to buy mortgage-backed bonds. Let's take that risk from the banks. But, I don't know about you. I'm not seeing a problem in the mortgage market for the last 5 years.
No, it's incredibly robust.
Yeah, and here's the Fed been buying $17 billion a month of mortgage-backed bonds. Many people feel this is just the Fed giving the bailout to the banks, their owners.
Yeah, 100%.
But now the point is, the Fed is not only no longer going to continue to buy mortgage-backed bonds, they're now going to start selling their portfolio in 3 months. The implication of that, further upward pressure to mortgage rates.
Yeah, and I think that adds a bit more pressure to the housing market overall, because you've had this backstop since 2009, really, where they've been buying this junk and supporting the market. And I agree with you. The analogy I've used in this program many times is it's almost like you have someone who goes into the hospital for a broken leg. Well, they go in for the broken leg. Maybe it's something more extreme. They lost an arm or something, and they're on morphine. They're all doped up, so they don't feel the pain. Things get better. They start to heal. They go to physical therapy. The person's fine. They're back to normal. They don't need anything, and you're still loading them up with morphine. That's the equation for this market.
It made no sense the Fed supporting the mortgage market while we were having a mortgage rally.
Well, it's so funny because we look back historically at a lot of these chairman of the Federal Reserve. You got your Powell and your Yellen and Bernanke and all these ones. And it's most of them, nobody has a real tarnished reputation. I think what's going to end up happening at some point, someone's going to get left holding the bag for all this quantitative easing and et cetera. Now, I'm kind of thinking that Jerome Powell's going, please let me make it to the end of my term without a major crisis so I can just say I'm done with this and move on, because, man, it really does feel like something is going to absolutely implode with regards to, all these Fed purchases, the inflation of the money supply, and just bring it on, man. I hope I'm short when it finally comes.
And I don't mean to sound rhetorical, but we are literally in an untested economic experiment here.
Yeah.
We are literally, no central banks, governments have ever tried what we're achieving here. By the way, if you want to find a central banker much maligned from the Fed, you got to go all the way back to Arthur Burns. That's the guy who gave us price controls under the Nixon administration, which really destroyed the economy when they tried to fix all prices and wages. Arthur Burns. How's that for trivia?
Yeah, you know what? I'm gonna have to claim ignorance. I never even heard the name Arthur Burns. But I'm not much of a Fed historian, other than I'm almost an abolish the Fed type person. Almost.
Just means I have to get a life. That's all it means.
No, it's funny. You should have a conversation with David Warner. He actually has autographed pictures from the last 5 or 6 chairmen on his wall at home. He is definitely he's the nerd alert when it comes to and he's the guy who's reading through all the fine tooth comb of all the statements and everything like that. All right, so let's see. The big stuff was we had at 50 basis points.
Right.
The whole market went absolutely apeshit yesterday when Steve Leisman asked the question at the press conference, what about 75 basis points? And Jerome Powell said, we're not even thinking about that. I personally think that's BS. I just think he's trying to keep things calm, right?
Yep.
Because he said 50 basis points is on for the next 2 meetings. What's your take on the Fed's, I guess, transparency and communication about rate increases going forward?
Yeah, no, I think in fairness to the Fed, we have to give them a little bit of credit. I don't mean to mimic Jamie Dimon, who I don't often agree with, but Jamie said, let's give this a chance. Let's when the Fed's saying we're got to be data determinant, I mean they're really walking a tightrope here. Yeah. The issues of addressing inflation but not destroy the economy, soft landings. I mean, and all of this has to be somewhat data determinant. My only concern is when I hear the Fed start talking, and if you listen to the press conference, what concerns me is the press keeps talking about what is normal yield, right? What's normal yield? And it's even gotten into the terminology, and even Powell was talking about, well, we talk about a normal yield of 2 to 3%. Mm-hmm. And where did he get that number from? He admitted it's just kind of a topic of discussion.
Right. We looked at that.
Yield should be a rate of return that is in excess of inflation. Well, if the Fed wants to actually do a normal yield, guess what? Inflation's running at 8%.
Yeah.
Anything less than that is not a normal yield. So where Powell comes off saying, well, we kind of think a normal yield is 2 to 3%. Okay. Mm-hmm. I think a normal stock price should be 100. So what? It just blew my mind that they kind of said just haphazardly, we're using that as kind of our topic of discussion for normal, quote, normal yields.
Yeah, and this is the thing that I've learned over the years is how there is a tailoring of opinions and data to fit a time frame. So you look back at the financial crisis, right? Markets are going to hell in a handbasket. Unemployment was getting into the double digits, and like, oh my God, this thing. And they said, look, we're going to keep doing this until we get to full employment. And of course, at the press conferences, they ask him, and Bernanke goes, full employment's 5.5%. Okay, great. Well, what happened when he got to 5.5? You just kept on buying. You kept on supporting the market. We dropped from 5.5 to 5 to 4.5 to 4 to 4.5 to 3.5.
Exactly.
And tomorrow we actually have our unemployment rate numbers coming out. Everybody, the previous was 3.6%. They're expecting 3.5. I personally am going on the side. I think you'll probably be 3.6. I don't think we're going to drop on the unemployment numbers, but. Who knows? That's the other variable that we have to look at, Bill, with regards to your stagflation argument, right? Stagflation is soaring inflation, or stagflation is high inflation, check. GDP contraction, slow growth, checking, right? And that's second point data. And the third one's unemployment. And you definitely don't have that unemployment number that you're looking at because it's been dropping and dropping and dropping. I'll bring up the unemployment rate here for everybody to see out at home. Here's what it looks like. It's not surging to the upside. And of course, we know that this can change very quickly. There was a gentleman earlier, I believe, let me make sure I give some props out here to whoever was typing in that one. Where was it? Oh, great. Now I've lost the train of thought here. But he was talking about in the unemployment number being 3.6%. Well, not really. 3.6 is the U3 rate. Most people that are real traders and market technicians going off the U6, which is 6.9. But either way, the chart of unemployment has certainly been drifting lower and lower and lower. And there you see right there where we were up, right around 15%. Now we're at 3.6. So you don't have that unemployment backing you for stagflation quite yet. Is it coming?
I'm going to respectfully disagree.
Love it. You can disagree all the time, but I love it.
You don't mind. Only because, as you did, because the press does, right? The press focuses on the U3 number, and that's what everyone's going to talk about tomorrow morning at 8:30 and 15 seconds. But as we've talked about, that U3 number is so is so misunderstood. All right, that number only measures the people that have lost their jobs in the last year. That's why they don't even call it the unemployment number anymore, because it's so misleading.
Yeah.
If you lost your job at the beginning of the pandemic because your restaurant closed down and you haven't worked since, you're not even included in that 3.4 number we're going to talk about tomorrow.
You've fallen off the books.
The Social Security rolls, which is what that number is based on.
Right.
So what I would strongly encourage, and you hear more people talk about it, if you want to really talk about the unemployment situation, we got to look at the participation rate. right? Let's look at a broader segment of the economy, not just those people who lost their jobs in the last year. Yeah, they're getting jobs again. We knew that, right? There's 2 open jobs for every person looking. So the fact that the unemployment rate is at 3.4, it should be because you're only talking about those people who lost their jobs in the last year. The participation rate, which was at 63.2% before the pandemic, and then dropped down to 60%. We lost 3% of our population lost their work or decided to leave, right? Could be, they just are not working. And we've only now, as of last month, only made back half those jobs. Mm-hmm. Half the people that left or were forced to leave the workplace during the pandemic are not working now. And that's a very different picture than saying the U3 rate is 3.4%. Politicians love the U3 rate.
Of course.
It's and this is not a partisan issue. I don't care what party's in power, because it makes the economy look better than it is because people don't understand what it's really measuring.
Yeah, I call it the mushroom society. Keep them in the dark and feed them a bunch
Absolutely.
of bullshit and you got mushrooms.
Look at and tomorrow, I hope the talking heads talk about it. Take a look at the participation rate. We're looking at about 62.5 is the expectation. We just made back just over half the jobs we lost in the pandemic. That's all.
Yeah, Dave, I'll give it to, so Mark was the one initially said the unemployment rate is 3.6. Correct, that's the stated rate of U3, but again, most are going with the U6 rate because those who are marginally attached to the labor force, which is certainly a much higher number. Either way, again, that trend line is down. We are seeing that the number's declining, but still, there's a comment here from Dave Cordell, which is a good one. He says, do you think the COVID market crash and rebound, combined with stimulus checks and gamified trading apps, have reduced the desire to enter the workforce? I think so.
I think so. I think it's just existentially people are looking at their lives as a result of this.
Yeah. I have a couple friends
so many factors
that have decided not to go back to work. I got one particular who started up his own business, and I got another one who is doing stuff completely off the books, under the table cash jobs and collecting unemployment. So, unfortunately, it is what it is. But at some point, when you have that unemployment number down at 3.6%, as it shows the U3 rate, I guess the question for anybody is, how much lower are you going to go? I mean, here, I'll show you the chart of the unemployment rate. And I'll go all the way back into 2000. I think I go all the way back to 2000. And you'll notice on this chart, it hasn't been really lower than we have in any of the really good economic times. Even, in 2003, when things were going pretty darn good, well, we were up at 6.1%. At the lowest unemployment we saw in 2007 was down around 4%. Now you're at 3.7. I mean, this is historic levels of unemployment. But again, I think it's misleading because the data, in my opinion, is a bit miscalculated.
And it's just showing, I would make the argument, a statistically insignificant portion of the entire population. Mm-hmm. For those people who lost their jobs in the last year, they were able to get new jobs. That's great. We knew that already. There's 2 jobs for every person unemployed.
Yeah, gotta love it. Get out there and get to work. Right. Big Ed says 1.5 million jobs open, but unemployment rate and participation dropping equals higher labor rates equals more inflation. Agreed. Totally.
He's got it. He's got it.
Margaret asked an interesting question. We'll digress here a little bit. Who's your favorite economist?
I have to say, and currently Dr. El-Arian, Mohammed El-Arian, formerly neighbor of you out there in Newport Beach, from PIMCO. I have the greatest respect for him. He's just done great work. I think very highly of him, and it helps that I seem to agree with him on most of what he says. So that obviously enhances his prestige in my mind. And he's also very vocal. He's on MSNBC. He's a former PIMCO director. I'm sure most people are aware. A Lions director from the insurance company. Mm-hmm. And now he's, as a part-time job, he's also the president of Cambridge University in the UK.
Yeah, that's what I do. It's what I do in part-time. What do you do part-time?
Right, exactly.
University president at Cambridge.
Spare time, but I have great respect for him.
Yeah, so Boss Poopa says Hayek. Yeah, I have talked about Mohammed El-Arian. I definitely have hold him in a lot of high regard as well. When he's almost like an E.F. Hutton for me. So when I see him speaking about something in particular, I definitely listen to what he has to say. And I think when that question was posed, I think it was normally dealing with, the old ones, your Murray Rothbards, your Keynes, or something like that. Right. But, that's all in the past. They're not making economic forecasts. Mr. Maynard Keynes is done. He's not making any calls anymore. So.
Yeah.
Yeah, Mohammed El-Arian's
not
great.
too many market calls coming from him these days.
Big Ed says I follow him on Twitter. I follow him as well. You got to keep the people who you think are very influential and important close to your circle of vision. Tell me about you mentioned that on the 10th of this month, you're doing an XLT session, talking about more in depth on ibonds. Okay.
Yeah.
So you have an XLT.
I'm really trying to ring the bell on these ibonds
Should.
because I think they're such good value, but more importantly, they're being undermarketed because nobody's got a vested interest. So I'm going to ring the bell for that for a while. So I've got a May 10th XLT session scheduled. We're going to talk about that. And as long as we're on the topic of index inflation bonds, I'd be remiss if we didn't talk about tips also. Mm-hmm. So we'll throw them in the discussion as well. So that's on May 10th. And then we've also got the signature series. I do a 3-day interest rates, the economy, the Fed, how it all ties together with bonds and all of that. And that session is running at the end of the month. So we'll do that. And then, so because of that, every week leading up to that, we do what's called a showcase, where we take a little bit of material from that large session and offer it out to the whole OTA community. So those showcases will run pretty much every Thursday. I had to move this one for you. It'll be tomorrow. For the rest of the month, on Thursdays, I'll be doing the showcases, and people can interact with me there on those.
And then your bond aid. Tell me about bond aid.
Yeah, well, the bond aid is the program, the 3-day program at the end of the month. That's what the showcase is leading up to. Right. So for the 3 days, we get into understanding the economy, the Fed, how interest rates affect other asset categories, like this week shows us. And then we get into different bond categories, bond ETFs, how to buy bonds, how to trade bonds. So that's a 3-day committed program that'll be running on the 25th, 26th, and 27th of this month for OTA.
Nice. Well, I will put a link in the chat for everybody. That is a link to his course. I believe, let me see, yes, they told me to put this in there as well. If you put in this promotion code, since I know that a lot of people are probably watching or listening to the podcast, you go to otacourses.com/signature-series. Oh my goodness, that's a long email. Forget it. Just go. I'll put it on my Twitter feed. But if you put in this code here, which is Bill22, that gets you a big discount, I think. I don't know.
Yes, sure. That's what I've been told. They're doing a promotion on this program, class.
It's an extra $500 off. Not bad. All right, so we got your link
out. These classes, my business is mostly institutional, and working with the OTA community, you guys are honestly a lot more fun than my institutional clients. So we have a good time in those classes, and then we do the companion series where we catch up every week after that.
We're definitely not as serious, but it sounds like your schedule's starting to fill up with more institutional teaching, Bill. Am I going to start to I'm not going to see you much here anymore? What's going on?
The summer months are tough. I'm not going to lie. Starting in June, because Wall Street hires this army of young kids right out of college and grad school, and I come in and help work with them. So Citibank globally, and I'll be working with them, has 1,200 new hires this summer.
Wow.
It's their largest program ever. BlackRock is going to do 650. So there's this army of new hires coming into the industry, and I'm fortunate I get to work with a lot of them and help train them when they come in.
Mold their fragile eggshell minds.
Or corrupt them, depending on your opinion.
Absolutely. Anything else you want to impart on us? Anything fun, exciting?
I think that's about it. Again, the only thing that I would stress is I do want to give you guys some good news, because I feel like I'm always the harbinger of doom. I did a class last week, and somebody said, when's the bread lines coming? I was getting so depressed. If I could hit you with some good news, at least, is, you and I have been talking about the deficit and the inability of our elected officials to manage a budget.
Yeah.
And the fact that, last year, in areas of stimulus, the government had to borrow unprecedented amounts of money, and we had a $3.4 trillion deficit last year. Good news is that deficit is down by $350 billion this quarter. I would make you the point it should be down because we don't have stimulus money the government is providing any longer.
Right.
So I don't know that this is a lot to celebrate, but at least it's good news. And in fact, it looks like for the year, we'll be down 1.5 trillion. So the government's borrowing less, and I think that's good news. I would make you the argument the government should be borrowing less because we don't have all this stimulus money floating around.
Mm-hmm. I guess the question is, can they borrow much more? I mean, goodness, how much? What else are you going to borrow for, man?
Unfortunately, the answer seems to be yes, they can borrow more.
Yeah. Buzz Lightyear is the official mascot of the Fed now. Infinity and beyond.
Exactly. So, so the deficit is down a little bit. I think that's actually some pretty good news.
All right, we got a little sparkle of joy for our wall of worry here. But, who knows how this is all going to pan out. As I mentioned, guys, again, it's not meant to be doom and gloom or anything like that. It's just saying these are the facts as we see them, and play your cards how you feel they need to be played. Some might be bullish, some might be bearish. Take it or leave it.
Yep. And like we saw with the ibonds, there's opportunity everywhere, right?
It's funny because I'm sitting here thinking, I got 10K lying around that's just kind of sitting there dormant. I lock it up for 5 years at 9%, maybe get more than that. Sure, why not? Yeah. It's safer than crypto.
Yeah. Everything's relative to crypto, right?
It's safer than crypto. Well, it's funny, Bill, because I can buy stable coins and earn 18% right now, but it's not FDI insured, it's not government backed, it's kind of sketchy. You give me 9.6, I'll take that as a very safe haven return.
Yeah,
so.
Literally government guaranteed, and yeah, exactly. In today's market, that's one heck of a rate.
Absolutely. All right, Bill. Well, hey, thank you so much. Best of luck to you in your sessions coming up here next week, and I always appreciate having you on, my friend. Thank you so much.
Always a pleasure talking to you and the community out there. So be well, guys.
Right.
Be well. Thank you, Marlon. Great talking to you.
Bye.
Cheers.
Hi, that was Bill Addiss giving us some insights into ibonds, 9.6%. I'll probably share the news. I'm probably going to go buy 10 grand worth of them. Just why not? I have some cash and may as well put it somewhere where it's going to be earning 9.6%, especially if I know I'm going to be holding on to it. That's kind of my rainy day fund. Sure, why not? Keep a little 10 grand in that rainy day that for the first year, not going to cash it out at all. Probably won't catch it for the next 5, but if I do, hey, at least I earned some great interest along the way and beat that inflation aspect. Bill will be teaching a signature series for Online Trading Academy. We put the link in the chat just a little bit ago, so you can find the link there. The code is BILL22 if you want to receive $500 off the course of that class as well. And when you get in there, say hi to Bill. He always does a great job. All right, let me real quickly bring up the rest of our announcement stuff here for today. I didn't bring up any charts, which was interesting. Let's see, how much time we got? I'm going to have to get to, Michael, I'm going to have to get to your question tomorrow because I got to wrap up here. I got some stuff I got to take care of. So let me go straight to our economic calendar. Better investment than e-bikes. No, Margaret. I can make way better investment than way better investment with my e-bikes. I can make a 50% rate of return on my e-bikes in no time. So, let's see. I'll read this one real quick from Les, since I know you're here, Les. It says, what do you think about this? With such a large drop today in the index, we get a bounce tomorrow, but it turns out to be nothing more than a dead cat bounce. Well, as you guys might remember at the end of the show yesterday, I said, here's what I think is going to happen tomorrow. And I thought we would probably see a positive day. I thought we'd see a breach above those supply levels that we hit. So here's your charts. I thought what we would see is a little bit of a break above this blue line, maybe for a day or two, and then give it all back and come cratering down. I didn't expect it to have this huge move, although now in hindsight, I'm sure anybody who marked this level is like, see, supply and demand zone works, I called this. I actually thought it was going to go slightly higher and then come back down. But all in all, a very bullish down day for our overall equity market indexes. And I'll run through some here. Bitcoin just absolutely getting slaughtered today, down 8.8%. Here's your NASDAQ, which at one point was down over 5%. Huge down day. I'm not a shark. You've got the Russell was down 3.89, S&P down 3.3, the Dow was down 3%, but there was some stuff moving to the upside. You have here it's a red candle because of the gap up on gold, but on the day, gold was up, and then crude oil was up as well with a green candle. Believe it or not, a green candle. And it's actually broke above those highs that we established on the 18th of April, which I think is important if this is going to start to move back to the upside. Tom says huge moves are still in the yellow box since early February. Oh, well, we're at the bottom end of it. We are stretching the box out a little bit if we do that on the Russell 2000. Let's see. Would you call that a bearish engulfing candle? On which day? Most likely no, because typically a bearish engulfing candle is going to happen at an uptrend. And you notice that this is at the bottom of a downtrend. It's just, I don't know, I wouldn't call this an engulfing. Personally, I guess statistically, if you took the two candles side by side, then possibly. But remember, the way an engulfing works is, if we look at this one, technically not an engulfing pattern. Why? Because this red candle, this red body here, needs to engulf everything from the day before, and it does not. Let's see, on the Dow, not an engulfing because this red candle doesn't engulf everything the day before. The Russell doesn't engulf everything from the day before, and neither does the NASDAQ. So neither of these technically, Chase, are bearish engulfing candles. Number one, the formation isn't an engulfing, and number two, the location wouldn't make an engulfing pattern in my book. Something like this, let's see, that's a Harami formation. I'm going to see if I can find one that, this is arguably a engulfing pattern right here on gold. See where it peaked on gold? Now, some people will say it has to include all the tails, but most will say that the body of the previous day has to fit within the body of the next day. So this would be an engulfing pattern in a lot of people's books. Let's go back there. So with that one. Anyway, we could spend a bunch of time going over candles. Okay, so let me go to economic calendar stuff for tomorrow. Here is what is cooking for mañana. Make sure I got this for mañana. Actually, no, this was actually for today. I didn't update these. Sorry, this was actually today's, though they actually came out with earnings today. And I do have your earnings for you. Let me bring up that earnings just a second. That's unprepared on my part. Here is your earnings for today. Boom, I knew I had it set. There you go. The results were in. So Square or Block beat, and you had Dominion Energy just barely missed. The ones that beat were going to be WestRock. You had Crocs, ConocoPhillips, and then Shopify missed and was down 75% of their earnings and dropped by about 15% on the day for Shopify. So maybe some buying opportunities coming into play here for Shopify going forward. And then here's what's happening for tomorrow. I'll bring this one up the same way since I don't have it on my slides. If you're looking at this, take a peek at a lot of the big data that's coming out for not just the U.S., but international markets. So you have construction PMI coming out for the U.K. tomorrow. They also have some of their MPC members speaking. You have Man speaking and Pill. That's a tough two names. Man Pill. Canada has their unemployment rate. So does the U.S., and most of that is happening 1 hour before the U.S. equity markets open. You have their U.S. unemployment rate and average hourly earnings and non-farm employment change, as well as FOMC member Williams will be speaking, Bullard and Waller. So it's going to be a busy day tomorrow with regards to comments. Curious to see how it all shapes up for tomorrow, because obviously Wednesday, huge, big day to the upside, down day, ugly today, and then who knows? My gut tells me that you're going to have people going, I don't want to go home on the weekend with this. I'm just a little too nervous, and you'll probably see a little bit more downside move tomorrow. I gotta laugh at that one, Tom. So for those that might not get that little bit of an inside joke, Tom says, by the way, my favorite economist is Peter Navarro. Don't feel bad. He left Mike Pence out of his Operation Warp Speed book. I actually taught a class for Peter Navarro at UCI. He brought me in a couple times for the master's program to talk about direct access trading when I was back on the trading floor days. And there was a 2-hour session that I gave for him, and just I had filled it with amazing stories. It was just such good stuff, and it's all personal stuff that happened to me. And then he wrote a book called "If It's Raining in Brazil, Short Starbucks" or something like that, or Buy Starbucks. I forgot what the name of that book was. And in there, there's just page after page of my stories. These are literally my trading stories. I'm like, you son of a bitch. And at the end, it just says, there's one little word. It's like, thanks, Merlin. You should write, this book is based off the stories from somebody else. I completely plagiarized and stole his stories, but, And now he works in politics, which I guess is very appropriate for people who aren't very scrupulous. All right, let's see. I am going to wrap things up. Tomorrow I have no guests. I will have a glass of whiskey because I am very excited for this weekend. I'm off to go down to San Diego for the weekend, which should be an exciting thing, and go check out a Padres game, go check out old downtown San Diego. But we will have a trading show tomorrow. Now, next week, as you guys know, I will probably not have a show on Tuesday or Wednesday because I'm going to be in Las Vegas doing the Money Show. If you are going to be there, I had the slides here a second ago. If you're going to be in Las Vegas, come check me out. You don't have to attend this event, but here is the event that's going on. I'm speaking Wednesday. I believe it's at 11:30 or 1. Always glad to talk to everybody about things or just meet you there and have a drink somewhere. But I'll be at the Money Show Tuesday night on the 10th. I'll be wandering around probably Bally's or Paris or some casino over there, which is where the event is at. And then my presentation and a meet and greet will be on the 11th for that. And of course, there is a discount. I don't know what the discount. I think it's OTA 50 gets you $50 or 50% off or something like that. All right, cool. Well, that's going to do it for me, everybody. I hope you enjoyed this show with Bill Addiss. Always enlightening. The 9.6% for ibonds. That is a very tempting place to park some cash for a little while. Maybe some of you would enjoy that one, and you do so at your own risk. Be careful with that one. Obviously, nothing is risk-free, but gee, when you're buying 9.6% government-backed yield, that's safer than a lot of other areas of return. That will do it for today, everybody. I will see you all on tomorrow's show. If you got questions, comments, feedback, put them at TraderMerlin@gmail.com or put them down below the YouTube video, and I'll see you tomorrow.